Hello and welcome to this particular session. So this session you're talking about internal versus external liquidity range, and basically doing a simple breakdown for you to be able to understand the difference between internal and external range and how we use both of them. And this is just a continuation of the video that I shared on Monday. So if you have not checked the one that I shared on Monday on liquidity, please make sure you watch that before you watch this particular video. And at the end of the video, I'm going to embed that Monday's video on this particular video, right? So and this is just a series of the TFTL education series that I've been doing, about 52 topics. Right now, I think we are maybe probably 20 something topic. So it's quite an educative series because the moment you go through it successfully, then you realize that your trading game will shift dramatically. So you'll be able to minimize your losses and maximize your profits, because the key theme that is riding through all of these videos that I'm doing is structure, liquidity, and time, right? So let's get into it. So what you need to understand is that most traders, they see price like it's moving inside a range and think that the market is random, but the market is not random. Okay, the reality is price is usually moving from one pool of liquidity to another. So understanding this helps you to remove confusion as a trader. So that tells you now, if you don't understand liquidity, okay, so if you don't understand liquidity, the internal and external liquidity, then ranges can feel confusing. When the price is moving in ranges, it can really feel confusing. And again, what you need to understand is that price breaks up, then down, then back again. Okay, so therefore, once you understand the liquidity, where the liquidity sits inside a range and where it sits outside the range, the movement now becomes easier for you to interpret as a trader. Okay, so and that will be the learning objective for this particular video, understanding the difference between internal and external liquidity, and also being able to recognize where price is likely to target next, using the concept of liquidity. So this video is mostly for traders who feel confused during consolidation, or struggle to anticipate range breakouts, or get trapped trading the middle of the range, or want to understand what price is really targeting. Right, so now let's get into the gist of this. Right, so what is a range? Okay, what is a trading range? But before even we talk about what is a trading range, you have to understand this. Here is a key shift that you really need to understand upfront, that price often clears liquidity inside the range before targeting liquidity outside the range. So we begin internally, we go externally. Internal, external, internal to external. Okay, and once you see this pattern, many market movement stops feeling random. Now, what is a trading range? A trading range is basically where or a trading range forms when price moves between a clear high and low. So during this phase, you find that buyers will always be defending the bottoms, sellers will always be defending the tops, and liquidity will build on both sides. And therefore, inside the range, traders place stops above minor highs, stops below minor lows, breakout orders are near the edges. And these actually creates layers of liquidity or clusters of liquidity, like what we discussed in the previous video that I posted on Monday. Okay, so and the market often clears this liquidity gradually. So the reason why we are saying that liquidity, the basics of liquidity is that liquidity is equals to available orders. And these orders, they are where we have stops for the retail traders and entries for the institutions. And therefore, the reason why we are saying that large players will need liquidity to enter or exit positions, and price will naturally move towards this liquidity pool. Okay, so it's good to understand that, very well explained in the previous video. So the reason I'm saying, before even you continue watching this video, if you have not watched the previous one that I did on Monday, or the last one video that I did, make sure you do, so that we can be able to move together. And now, internal range liquidity. What is this that we are calling internal range liquidity? Internal range liquidity refers to liquidity inside the boundaries of the range. Examples include equal highs within the range, equal lows within the range, and minor swing highs and lows, and also consolidation clusters. Remember also order blocks, fair value gaps, they are also part of internal liquidity. I'll be showing you in the chart in a few. So price often sweeps these internal levels first. Why? Because you find they contain these levels, these internal levels, they contain smaller liquidity pools, and therefore clearing those small liquidity pools help balance the order flow before the market targets the larger liquidity pools. Okay, so that is the reason why internal liquidity gets cleared first. Okay, so markets often sweeps internal liquidity first to balance the order flow. Then this creates now the back and forth movement inside the consolidation phase, right? So now once you understand that, I'll be showing you in the chart examples of internal liquidity, but let's first of all finish the theory so that we can go to the practical. External range liquidity, what is this? External range liquidity sits outside the range boundaries, and these are the more obvious targets: the range high, the range low, the stop loss clusters beyond the range, and the breakout orders. And these areas, they contain large pool of liquidity. And once internal liquidity is cleared, price often moves towards the external targets. And that's when real breakout or major reversals often occur in the markets. Okay, so typical liquidity sequence, how does it appear? All right, or how does it appear? So you find that first the price takes out the internal liquidity. Okay, so these are just three steps of how it happens, how to use this concept of internal and external liquidity. You realize that these three practical applications, this is what definitely happens in the market, and this is what you need to recognize. That first you need to there is the internal liquidity gets cleared, then momentum builds, and then now we see the external liquidity. All right, we see the external liquidity becomes the target. So what you need to do, how to use this concept in trading: number one, avoid the middle range. The middle range will always contain the most noise. High probability moves occur near liquidity targets. Okay, so you have to understand that. And the reason why we are saying internal liquidity gets cleared fast. Then number two, watch for internal sweeps before breakouts. If internal liquidity hasn't been cleared, the breakout may be premature. It might be a fake out. And then now you focus on external liquidity as your target. You can use the external liquidity as your target. Okay, so that is now the process or the trading implications. External liquidity often becomes the destination for stronger moves after internal liquidity has been cleared. So when internal liquidity is cleared, attention now shifts to the larger targets, that is the external liquidity. Okay, so then there are some common mistakes that traders make. Most traders trade every movement inside the range. No, that is not supposed to be the case. You have to look again the points of interest which you are using to take your trades, and also looking at now those liquidities being cleared. All right. And because if you look at how professional traders do it, professional traders wait for liquidity alignment. They wait for liquidity alignment. You know, when I began trading initially, I didn't understand this concept of liquidity. So I used to trade every move inside a range. And so for me, I could say it's a support and resistance. So that's a range, because that's the basic concept that I began with. But once I started now learning the price, understanding ICT, smart money concept, I came to recognize the aspect of liquidity. And the moment I start understanding now or recognizing internal liquidity sweeps, that the price sweeps internal liquidity going to external, I stopped chasing the noise and focused on the real targets. And this helps to improve my trading dramatically. The patient increased because I'm not chasing every setup. I had to get the patient to wait for the correct setup. Okay, I had to wait for the patient to wait for the correct setups. So what are the key takeaways? Is that price targets liquidity. So internal liquidity is cleared before external levels, and understanding these will help you improve your timing. Okay, so and why does, maybe someone might ask, why does internal liquidity gets cleared first, you understand that inside the range, price often moves like a magnet between smaller liquidity pools. And this now creates the back and forth movement that traders see during consolidation. For example, price will sweep an internal high, then sweep an internal low, then build momentum towards an external level. Okay, so therefore, without understanding this process, traders often get chopped up in the middle of ranges. But when you recognize internal liquidity sweeps, you can avoid trading the noise. And let me now take you to the chart. Okay, let me take you to the chart. So let me share my screen. Let me share my screen. So there is the chart. You can see the chart there. So when you look at this particular chart, I want to concentrate on this piece of price action. Let's begin by looking at where the liquidities are. So this is the external liquidity. See these highs here. We have some external liquidities at that particular point. And what is the name of these external liquidities? These we can call it buy side liquidity. Okay, buy side liquidity. Then below here, right, below here, we have some other liquidities here. Right, below here, we have these also. These are buy side liquidity. Right, these are buy side liquidity. Okay, these are buy side liquidity. Buy side, sell side liquidity. All right. But also, look at this, the high of this particular day. Okay, we have the high of this particular day because the major liquidity levels or the external liquidity levels, we are talking about weekly highs or weekly lows, previous daily highs, previous daily lows, monthly highs and lows, even session highs and lows. Those are external liquidities. So we have these previous day here. So that is the buy side liquidity, right? And then we have this other one here. Okay, so we have this other one here. This is the low of this particular day. Actually here, that's where we have the low of that particular day. So the sell side liquidity. So now look at how the price is moving. So we move from this point, we come all the way to this level, we take out the sell side liquidity. This is the external liquidity, right? Then now what we want to identify at this particular point, as well as let's also mark this one because these are low of that day. Okay, so there is also the low of this day, but this price came all the way to this point to take out those liquidity. So let's mark that as our external liquidity, SSL. All right, sell side liquidity. So all these are external liquidity. External. All right, external. You can just write external so you'll understand. Okay, external. So even this one, it's also external. Okay, so it's also external. These two is external. All right, these two is this is external, this is external. So now let's look at how the price is moving here. Remember, this is a range. So we begin, this has been taken out. Okay, so now because this has been taken out, we want to look for buying opportunities. All right, we want to look for buying opportunities. So in the bigger picture, where is the liquidity resting? The liquidity is resting here and also here. So our target will be around these levels, right? Our target will be around these levels. Now, what you want to do is you can go to the lower time frames. Let's say maybe probably, let's even say 5 minutes time frame. Okay. So now on the 5 minutes time frame, what we want to look at here is now the internal liquidity. Okay. First of all, you identify what the shift in market structure or the shift in market structure which happened around this particular point after these liquidities has been taken out. Now we see the price coming, taking this, and then now we start marking our order blocks. Remember, the order blocks are internal liquidities. The fair value gaps, they are internal liquidities. So you first see the price coming to this order block, and then now you start taking your buying opportunity. Why is the market buying to? The market is buying to, our bigger target is this level, right? But you'll find so many entries before even the price reaches to this level. So what do we have here? These are also internal liquidities that are being taken out. Okay, internal liquidities, these lows, right? These are internal liquidities because they are not major liquidities like previous daily high, previous daily low. So all these, and then now the price create a shift in market structure. So we see now the first entry at that particular point. Okay, so again, this is where we have a BOS, internal liquidity. BOS is an internal liquidity. It's being taken out. The price, now you mark your point of interest, the order block. So the price comes to the order block, and then now it displaces on the upper direction. Of course, you want to mark during the kill zone. So the price came to this particular point here at 445. Then it played around this particular point, but initially we see the price push up. Okay, so again, as it is pushing up, here we see again some internal liquidity is being taken out, right? So we wait for a displace, a shift in market structure. There we have that BOS, or a shift in market structure, and then now we see the price coming to the order block again here during the New York kill zone, right? So, and then now the price displaces as it pushes up. Of course, if you are scalping, you might target maybe probably the internal liquidity is here. So the price comes and takes out those internal liquidities, then it pushes up almost to our external liquidity. So we are moving from internal levels to external. Then some point here it pushes up, then it pushes all the way down. Remember, we have not done what? Reached this particular level. So it comes again all the way down to clear again these external liquidities here. So these external liquidities again are cleared, right? So, and again, you repeat the process. So you mark the internal levels. So these are the internal liquidities, right? So we have the BOS there, and then now we have the price come to the order block at this particular point, and you get your target. So this is internal between the range, this one, and this external buy side liquidity. And then now the price pushes, and as it pushes, it's also creating some internal, it's also taking out some internal liquidities. So here we have those liquidities being taken out, internal, and then now you mark your order block. So this is the order block. We said when we have a candle with a long wick, we can factor the second candle. So the price comes there, and then now we see the price displace. Okay, so you have an entry, the price continues to push up. So it creates another internal liquidity, the BOS are internal liquidity. Then we see that the price coming to an order block, then we continue pushing higher. So remember, our target is this external liquidity, and until that particular point we see the price coming to that internal liquidity, and the price hitting the external liquidity. I mean, that is the bigger target here, the BSL, and the price hits that, and even it goes further to hit this particular level. So you see, we have traded from internal, right? We have traded from internal, from external, I mean, the range was external to external, right? But we have gotten our entries internally, and now we are targeting, because the external, this one was already taken out. So now we are anticipating the price to go back to the external, and the next external liquidity we are having is here. So that one has already been taken out. Okay, so now from there, that tells you we are likely either to see the price, because when now these liquidities happens, two things: it can reverse or it can continue. So if it's going to reverse, you're going to see a retracement, right? We are going to see a retracement of the prices, maybe to down to these particular levels again. And if that happens, we confirm with a change of character. Of course, now we'll be targeting the next liquidity, the next external level, which is of course the first one we have. This is the major one here, the low of this day, right? That is an external, and the high of this day, it's also an external liquidity. So we are trading right now within the range. So if we see a change of character, the next one we are talking about is this level, right? Or maybe probability we go to this level, because it's from internal to external. I know this might be quite a bit deep concept to understand, but the good thing, you have the video. You can pause, mark the charts as I'm marking, and see how the price does. And in case of any question, please, you can feel free to reach out to me, and I'll be able to help you understand this concept deeper maybe. But what I've shared here is really quite some deep information. So take some time to internalize that, and I believe it's going to come out well. Okay. So in a nutshell, what we are saying, we use the internal, you wait for the internal liquidity to be taken out, and then now you look for your setup, and you target now the external external liquidities, right? You target the external liquidities. This can look very nice for those people who do swing trading. So you can hold a position because of the liquidity is being taken out. You target these levels here. But for us day trader or maybe a scalper, you'll be working now with as you can see on these lower time frames, you can be working with the internal liquidities. The price coming here, and then you target, maybe your target, if you buy here, you'll be targeting maybe probably these liquidities to be taken out, which are internal liquidities. These are highs here, and then now you're done with your setup. But someone who is maybe probably looking at swing trading, therefore you can target from internal to external, right? So that's it from me, ladies and gentlemen. Until the next one, make sure you keep safe. So in the next video, I'll be discussing about order blocks and why most traders really mark them incorrectly, because if you misunderstand where the institutional activities actually occur, that can lead to poor decision entries or false fake outs, right? So thanks so much, and see you in the next one.